Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, doing the show after a really long time. So glad to be back on this. And I think I'm doing this show on a very opportune topic because our guests today, both of them in our studios, are talking about something which will make you believe that you don't need to spend too much of time thinking about when to invest in funds if you are convinced about investing in mutual funds. And that's what we talk about every single day on the MF show, right? When we do the show, that is mutual funds, because it's such a large investment bucket now. So what do I mean when I say this? That you don't have to think too much about when to invest in funds if you've decided that you want to invest. I think let's bring that topic up with our experts today. Chirag Patel, co-head of products and strategies at White Oak Capital, and Manuj Jain, again, co-head of products and equities at White Oak, join us in our studios. Manuj, good having you for the first time on the show. Thank you for joining in. Chirag, good having you again.
Thanks, Neeraj.
Okay, so now let's tell our viewers, and you both of you tell me as well. I saw this study that you did maybe about a month ago, if I'm not wrong, give or take a few days.
Yeah.
And in that, the few inferences and the few data points that you are showing show that अगर मैंने तय कर लिया कि मुझे invest करना है, then when do I invest doesn't matter. Why so?
So basically right now, as you know, a lot of new investors are coming in mutual fund. They like mutual fund product, and day by day we see SIP book is touching sky. So many a times people ask us that should I start my SIP right away, or should I wait for maybe a couple of months, maybe a couple of quarters, because many people believe that markets are on the higher side and everybody wants to start investing at the bottom. So we did this interesting study. So what we did, we took some 27 years of data of Sensex TRI. And 27 years is a large enough sample size. And we have taken all those periods when Sensex has corrected more than 20% from the peak. Obviously, let's accept this fact that only in the hindsight we will know what is the market cycle's peak and what is the bottom. But let us assume that one can time the market and you can precisely predict what is going to be the date for the market to bottom out. So we did this analysis and we come up with this analysis of 9 such market cycles when market has corrected more than 20%. So let me give you one example. So like all of us know that during global financial crisis between 2008 and 9, markets have corrected more than 60% from the peak. So if somebody would have started SIP in January 2008, which in the hindsight we know was the peak of that market cycle, versus somebody would have started SIP at the bottom of the market cycle, which is March 2009. So if you analyze, let's say, this data point, so somebody would have started at Jan 2008 at the top and continued invested via SIP till now, till let's say September 2023, the approximate return he would have got is about 13%. And during this period, whatever money he has invested, that would have grown by 13.2%. Versus somebody would have started right at the bottom, he would have made 13.3% XIRR. So the return differential is 0.1%.
Hardly anything.
Hardly anything. Another interesting point, so this is one aspect of looking at the data. Second point is that because the second guy has delayed investing by 14 months, so he has invested, let's say if you are investing 10,000 rupees per month, so you have invested 1,40,000 less as compared to somebody who has started just immediately without waiting for the bottom. So because second guy has invested 1,40,000 less by delaying investment by 14 months, those 1,40,000 rupees, 14 installment are not getting compounding benefit. So while the returns look almost similar, but the guy who immediately started in January 2008 has made more wealth as compared to somebody who waited for the bottom, and even if he would have precisely timed the market, he ended up making less money as compared to somebody who started at the top.
Time spent in the market, viewers. So that's the point number one. And point two, this is now, I guess our experts are saying this to be true simply because the anecdotal study, as they said, points to that whether you started investing at the top or you chose the bottom to the T, which is not possible, by the way, but for the sake of the study, if you consider that it's possible, the return was just 10 basis points, which is quite stunning. I mean, I mean, were there some anomalies that happened, Chirag, with this time period versus some of the others? I mean, what do the other time periods suggest, for example?
So I just give you just why it happens. For example, there is a correction of 1 month period. So from May 2006 to June 2006, it's a 1 month correction and market corrected by 29%. So those who have started an SIP in May, right, he has just one additional installment, which is of say 10,000 rupees. And those who have started at the bottom, probably they are lucky and they have started at the bottom. So they have invested one installment lesser. Today, the difference between the wealth is 80,000 rupees. So actually the one additional installment that has invested at the top of the market at that time has grown at 8 times, because at that time the Sensex TRI was in the range of 15,000, right? And today it is 65,000. So whether you are investing at 15,000 or a 10,000 kind of TRI level, today it is 65,000, so which is much more higher. So whether you are investing at 15,000 or 10,000, it doesn't matter today, right? So basically, when so for an example, if Sensex is at 6,000 or a 5,000, and it corrected by 20%, right? So it is a 1,000 point drop. Today, if it correct by 1,000 point, it is just 3%, 2%, right? So on graph, when you plot it over a long period, that 20% correction would look like a 3% kind of correction today.
Got it.
Right. So it doesn't matter a lot.
So yeah, for all the 9 studies, like I told you that in last 27 years, there are 9 periods when markets are correcting more than 20%. The difference between somebody starting at the top and bottom is roughly around this 10 basis point, except in 2020, because it has completed only 3.5 years.
Yeah.
So as you move ahead and as you complete your SIP for, let's say, 7 year, 10 year, the return differential goes away. But let's say in first year, second year, it will be shown, at least in percentage terms.
Got it. Okay, and a fair point. So maybe at 2011 or 2012, the numbers might have been different, but as the years have gone by, that difference has evened out to just 10 basis points. So therefore, don't think so much. Now, the note has multitude of other examples. You want to fill us in on some other details as well, which should ideally make our viewers and our readers understand that trying to time the market for mutual fund investments is futile. Let's go over maybe 2 or 3 other things one by one. What else?
Actually, Neeraj, why we carried out this study, because as a product head, we used to get a lot of queries. Okay, on which date I should start an SIP, which frequency, either I should keep daily, weekly, monthly, or whether I should do it on my own. Okay, whenever market correct, I will put my money or lump sum. So we get a lot of such queries and we used to answer them, right? But what we finally tell to them, that most important thing is you should run a SIP as long as possible. For example, 10 years, 15 years. This is the most important thing. I'm taking this quote from Howard Mark book, that what is the most important thing? You should do an SIP for 10 years, 15 years. All this matter, it doesn't matter over a long period of time. That is how it started. So one interesting thing that, people generally think that daily SIPs will bring higher return than weekly or monthly SIP. Right. So we do a same study over a 27-year period. Actually, whether you do daily SIP, whether you do a weekly SIP, or whether you do a monthly SIP, your return difference would appear after third decimal point over a long period.
Is that so?
Time.
And the long period is defined as 10 years, 15 years?
Yeah.
Okay. Wow. So you're saying don't only try to catch that top of the bottom. Don't try and think that you want to do a daily, weekly, monthly, or something like that, quarterly SIP. Do the SIP. SIP karo, returns will take care of themselves.
Yeah.
Wow. And this is universal across time periods.
Yeah. If you are giving decent enough time to your SIP. I mean, if you are doing this analysis with 3 months SIP, okay, so let's say if you are doing this analysis today, and over the last 1 week, markets were very volatile, maybe a daily SIP will look good. But if you are doing this analysis with, let's say, 5 year, 7 year, 10 year data, which is generally suggestible that if you're starting an SIP, you should run it for maybe 10 years, 15 years. There's no point doing an SIP for 6 months, 1 year. So what Chirag has just told you, that it doesn't matter. It is only adding transactions in your bank account statement. So somebody doing a monthly SIP will have 12 transactions, and assuming that people generally do 3 to 4 SIP. So 4 SIP, monthly SIP, which means, let's say, roughly about 48 transactions. But if you're doing a daily SIP and that to 4 SIP, one daily SIP means 250 transactions approximately. Multiply by 4,000 transactions in your bank account. For what? Why? For what reason? it is an operational nightmare and you are not getting anything.
True.
So what we are trying to say is that, okay, there is no harm in doing daily SIP, but you are putting too much emphasis on something which has no relevance in the over the long term.
Yeah, which is not the most important thing, right? So, for example, which date one should keep, right? Whether it is beginning of the one, whether it is new.
That's a very common topic. A lot of people say that, hey, I want to do this to the 7th of the month or the 15th of the month. Okay,
Yes.
My study has shown that returns ज़्यादा बनता है. You're
Whether
saying
it
that's
is
not
near
true.
expiry or
Exactly.
all those
So what's the
things.
study there? What's the outcome there?
So whether you do on any date, so there are 28 days, because keeping February in mind, if there are 28 days, if you do SIP for a 10-year period, all SIP give you more or less same return.
Wow.
Second decimal point. Sometimes day one SIP will give you a 1 basis point higher return. Sometimes it is on the second. Also, this is also random. If you are doing this study in September, so you may find that, okay, even I want to get this 1 basis point extra. So which is that date? So let's say it is second. If you do this analysis again in October, so that date will be, let's say, 7th. So this number also keep on changing depending on which date markets are up.
So what we suggest that, the day you get your income for a particular month, that should be the right day to have your SIP date.
Got it. So don't try to time the market. Don't try to catch the bottom or the top. Don't try to think about what day or what date you want to invest money in, because largely over long periods of time, most of these have not shown any significantly major deviations in returns from A versus B. I think that is the point that is coming out thus far. Okay, let's add more to the mix. What else did the study show up?
So, like many people say that my SIP returns are not good. I'm running SIP for last 3, 4, 5 years. Like during COVID time, even the 5-year returns of 5-year SIP returns were pretty poor, at least. So many people say that I've started SIP with a view of 10 years, but it's been 4, 5 years, and my SIP returns are less than average returns. Also, it is in single digit, or sometimes it is negative. Also, that can pretty well happen. So shall I keep on running SIP? Because then people start losing faith.
Yeah.
So in fact, our study says, whenever, let's say we are only talking about those investors who are doing a 10-year SIP. So we did this analysis again with 27 years of data on rolling return basis. So whenever your first 5 years SIP returns are pretty low, let's say below 8% also. Okay, let's take 8% as a hurdle rate. So those investors, those who get less than 8% return in first 5 years, end up getting above average return on a 10-year basis.
For the entire bucket of the portfolio.
So I think you would be
because they've got more units.
Yeah,
for every dollar, every rupee invested.
Yeah, precisely. So for first 5 years, so as you know, the initial units make you the highest compounding. So if initial units you are buying at a lower valuation, that is the reason why you have a lower XIR return in the first 5 years, you end up making above average returns. So you should feel happy that my first 5 years SIP returns are less than what I would have anticipated. If you are a genuine long-term SIP investor, genuinely going to run your SIP for 10 years. So that's this. I think.
Viewers, this comes in from a perspective that a lot of investors, equity investors, say that they love days when the markets are correcting because it allows them to buy the stocks of their choice at a much better valuation than otherwise. But yeah, the point is interesting. They've done rolling returns over 27 years on any 5-year block which had low returns, less than 8%. The overall returns over 10 years are higher if you have continued and stuck to the SIP and not tried to time the market. Okay, now Chirag, here's an investor. She's watching this show right now, let's say, and she's worried that due to her beliefs that the next 6 months, because of elections, because of this global geopolitics, what have you, the markets could be lower. And therefore she says that I want to stop my SIP for 6 months or 9 months and I'll restart again. All right, akin to timing the market. Our call of timing the market or not trying to time the market was for somebody who's starting the SIP at the top or the bottom. What about this investor? She has an ongoing SIP. She wants to stop. Does your study have any relevance, study done around this?
Yes, so basically the study number 7 that we called in our report, that, if you start at top or a bottom, for example, anything happened, any geopolitical situation or anything happened and market correct by say 10-20%. And you have stopped your SIP. So for example, it is a 6-month period. So the 6 months installment will not get invested, right? And at bottom, you again restart it, for example. But it depends on how far you want to go. You want to continue SIP for 8 year or 10 year. 8 year or 10 year market would be a different territory. At that time, not investing the 6th installment would be even at loss.
Okay.
Right. So I think you again lose this compounding opportunities.
Got it.
So the basic point is do not wait for all this correction, because when you are doing an SIP, you are automatically averaging at all instances, right? So you are taking advantage of all those instances. So for SIP, if it is an SIP, you don't have to worry about all those things.
Also, Neeraj, there will always be some reason or the other for you to delay your investments. Like today, you mentioned about some geopolitical events that we are discussing, or let's say election. 6 months down the line, there will be some other discussion points. So if you keep on thinking whether I should stop my SIP today or start it again, etc., I think the core principle, which you have highlighted many a times on your show, the core principle of a SIP is that you start early, you run it for a long period of time, you show the discipline of investing every month, or let's say every week or every day. Ultimately, this is 99%. Rest of the other thing, which day you select, which frequency you select, whether you pause for a couple of months or not, this is just 1% of the entire concept of SIP.
Got it. Okay. And keep this in mind. By the way, viewers, this study was done about a month ago. We're doing this show slightly late, but be that as it may, the study came about a month ago. But the findings are so interesting that I thought we should bring it out to our viewers. I haven't read the whole study myself because I was very inquisitive about how do I react when I hear about it first from them. So we've discussed 4 or 5 key takeaways. Is there something else that is a real standout feature that you guys want to bring out, Manuj?
No, basically, again, we try to answer some of the frequently asked questions from the investors. One of the questions is that obviously very loosely we all say that you should invest for long term. So the question is, what is long term? It is 3 months, it is 30 years, it is 10 years. So we did this analysis again using the rolling return, and we have tried to showcase that when you do a 3-year SIP versus 5-year versus 10-year versus 15 years. So obviously when you do a 3-year, 5-year SIP, there will be times when even a 5-year SIP can give you negative returns. While the probability is very low, but there is still some probability. The moment you cross 8 years, at least historical data suggests, historically, anybody who has run SIP for 8 to 10 years, till now, they haven't got any negative return from Sensex. So what is long term? At least if you are looking for at least positive return, so come what may, at least 8 year is the time period. Secondly, as you increase your time horizon from, let's say, 8 year to 10 year to 12, 15 years, the probability of you making a reasonable return, let's say reasonable return definition is double digit or maybe 12%, goes up significantly. So as you approach 8 to 10 years, the probability of making positive return is almost 100%, at least in the historical data. And as you increase your investment horizon to 12 years, 15 years, the probability of making double digit return is more than 90% approximately. So this is another question we try to answer using the long period data.
10 years. And viewers, I'll give you a small practical example. A lot of people might say that we may not have the capital to invest for 10 years. Somebody who drives my car, by the way, told me the same thing. And the tukka that he came out with eventually was that he split up his SIP amount into 2 or 3 and saying that some of this amount, if not all, I'll be able to keep for as long as 10 years. If I need some emergency money, I can take off one of the things without that, impacting the others. Though keep in mind, even if you have a bulk amount, you can always withdraw from that existing scheme that is undergoing as well. So don't get worried about whether the amount will be needed in 5 years, 6 years. Mutual funds are very liquid. You can redeem the money at a day you want and you get it in 1 day or 2 days as the case may be. So that shouldn't be a worry. Gentlemen, a lot of interesting ideas. Have I missed out on anything else that the study brings about?
So basically, one day, one of my friend called up me and asked me that, whenever my SIP get deducted, it is the high of that month. So we also prepared that data. So if you are the luckiest person and your installment, you are able to invest at the bottom of the market every month. And one, just like my friend who is investing at top of the market every month. And one who is the disciplined one, Mr. Discipline, he is investing on 15th. All return are same. There is a difference after decimal point.
Oh, is that so?
The basic principle one need to follow is continue your SIP for 8 year, 10 year, 15 year.
How long was this study for? Then that 27 years.
Yes. Even about the difference between the guy who is the luckiest one, who precisely predict that this is the day or the month, they end up making, let's say, 20 basis point higher return than the average return.
Wow, hardly anything.
Yeah.
Amazing. Okay. Well, gentlemen, this was a really interesting study. Yes, done a month ago, but relevant now, relevant next month, and relevant probably for all the next few years as well. So thank you so much for coming to our studios and giving us some sense of what this study entails. Really appreciate your time, gentlemen.
Thank you so much for inviting us.
Thanks, Neeraj. Thanks.
Pleasure was entirely ours. And viewers, thanks so much for tuning in to what I thought was a fascinating episode of the Mutual Fund Show. Do tell us if you liked it. Do send in your queries and we'll try and get them answered as well.